going to go ahead and get started. So Dustin, for all those who are catching this on a replay, we have asked, or any of those joining or joining a little later, we've asked everybody to put their questions in a box. There is a Q&A box at the bottom of the Zoom. So if you guys could put your Q&A or your questions in there in the Q&A box, then Dustin we'll cover those here during our Q&A portion. So with that, Dustin, if you want to go ahead and introduce yourself as people are jumping on so we can make use of this full hour.
Yeah, hello everybody. I'm Dustin Shervinka, the CEO and co-founder of Five Buffalo Capital. I just want to tell you guys, thank you very much for attending our meeting today. We truly appreciate everybody that's going to be here today and just taking 1 hour out of your busy schedules. That means a lot to us. I'd also like to give a special thanks to Christina for putting together today's presentation. It takes a lot of time and effort and a lot of hours making the presentation look nice and pretty. A lot of you guys probably already know my background, but if you guys don't know who I am and kind of my history of how I got started in real estate, I guess it goes back to probably the early 2000s. I was selling residential real estate out in Phoenix, Arizona. And then around 2007, we had the Great Recession. And at that point, we just couldn't sell any houses. And so, I sat around for a couple months thinking that the economy was going to get better, but it never did. It never recovered. At that point, I had to get a job. So I ended up getting a job with one of the biggest multifamily companies, or I guess one of the biggest multifamily REITs in the United States. At the time, they had close to 89,000 doors. And so at that time, whenever I was getting hired on with them, they were implementing value add strategies to their portfolio. And so when I came on board, they gave me basically a plan and strategy. And they needed us, the on-site teams, to basically execute it. So I worked for them for many, many, many years. And so I did probably over 1,000 repositions for them, which is the value add strategy. And that's pretty much what we do today. And so I did that. And I would say I really lost count after 1,000 units that I did. So it's probably over 2,000 units. But at that point, I seen every time that we'd reposition a unit, we would bump up the rents about $300. So most of their portfolio was 300 units or bigger. So if you kind of do the math, you're looking at 300 times 300, and over a year's period, that's like $1,080,000 in extra cash flow. So that really kind of gave me the aha moment in 2015. And so I kind of broke out on my own and I started doing due diligence on properties myself. So I eventually found this property. It checked all the boxes. It was in a college town next door to a hospital. Great location. It was on the main street going through the town. So basically, I used their same strategy, their plans, executed it. 1 year later, I ended up selling it for a major, huge profit. I used many different tax strategies, and then I parlayed that into many other different investments. So that's really kind of my path to generational wealth, and that's why we're all here today. So with that said, and just kind of getting a good bird's eye view, I'm gonna hand the mic back to Christina.
Thank you, Dustin. So my name is Christina Shervinka, and Dustin and I get this a lot. We're not brother and sister. We actually are married. We've been partners since, 2004 we got married. So we have known each other for quite some time, and we have been in business together since 2015 is when we did our first investment. And I always tell people we invested with our own money to figure it out, because if we're going to lose anybody's money, it needed to be our own, but we didn't. And so that's really parlayed us into leaving the corporate world and doing our own fund through Five Buffalo Capital. So really today, we're not going to talk a lot about the fund, because we really want to address questions that we get when people meet us in person and they ask, about real estate investing. They hear what we do and they have questions. And we also want to talk about 2025. 2024 was an interesting year, but we want to talk about trends that are coming into 2025. We want to focus on multifamily properties because that's what we do, that's our niche and what we know, and have had the most experience with. But in my career of 19 years in property management and real estate, I've worked on multifamily, public and private REITs. I've worked for single family scattered home rental companies, and I've also worked for build to rent, which is very popular. So I've worked in build to rent for both public and private companies, mostly actually, sorry, private companies. And so with retail investors. So all across the board, we've had a wide range of experience, and that's really what we bring to Five Buffalo Capital. And so with this, we want to give you guys some education. You should be able to see my screen, and we'll go ahead and get started. So as with everything, there are disclaimers because we are not financial tax or legal professionals. And so what we want to people to take away from this is that all investments have risk and not all investments are suitable for all investors. And so really, this is a document where we're going to cover some educational pieces. It's not an offer or solicitation of securities. If it were, securities do have limits on transfer. And so it's really meant to be educational and to provide people with some topics to go do further research on and to take to those legal tax and financial professionals. So we're not giving advice, we're giving points of reference for people to go further research. This is a confidential document, so we would like to keep it that way. And we will be looking at forward-looking statements. Things can change. We all experienced that in 2020. If your life didn't change in 2020 in some way, I don't know where you are, but there's things that can change. So there's assumptive statements, there's information that we're using that's based on sources we deem to be reliable, but I can't go and chase down all their sources. So just make sure that when you're looking at a document or a presentation, that you also go back and make sure it makes sense for you. And then, of course, nothing in this document or this presentation has been reviewed or approved by the Securities and Exchange Commission or any state regulators. You should always do your due diligence. So with that, we have a pretty big agenda. We have a little bit of time to cover it. And so, like I said, there will be a replay. So if I start to go a little faster, understand that there will be a replay for you folks to go back to. But we have a lot to cover and we want to make best use of your time. A high level summary, and just for folks who are new to real estate investing, just want to think about things and understand the trends we have seen in the real estate world, lots of different cycles and lots of different things that are popular. But within the last 5 years, you've seen a lot of folks going towards industrial. There was the whole thing in COVID of let's make it here, let's control the supply chain. So the industrial sector really took off. And then over the past few years, we've seen also private credit. So people not being able to go maybe to banks to get their credit, their capital. So they've been going to private funds. And so that's been kind of where you've seen these funds going. But multifamily is poised to come back to the forefront for investors in 2025 and 2026. And that's primarily due to three things, which are those stabilized interest rates. While they may be stable at a rate we don't like, there's still some stability there. The declining inflation, and I saw it this morning and it said, inflation's maybe inched up a little bit, but it's still not where it was a couple of years ago. It is declining back to a normal rate. And then of course, favorable valuations, which we'll talk about. So in the past 20 years, you saw a lot of the larger REITs and larger investors getting properties in the Sun Belt and the Mountain West, multiple municipal statistical areas. So those are those big like Denver, Atlanta, Dallas, Salt Lake City, Boise. You saw people go there. And so rent growth went up, supply started to get built. But now people are like, I can really work anywhere. And so demand has gone down in relation to supply. So we are seeing the Midwest and the Northeast markets actually with those lower supply because they weren't building, be able to create a better rent growth for their investors and their owners there. So we also have this cohort of high demand based on limited ownership, home ownership affordability, and a strong population growth. So these are all combining to be part of that supply and demand balance. And so we're projected to have a balance in supply and demand starting in the end of 2025, and we think that'll go into 2026. So with that, value added approaches are likely to see that greater recovery and performance. And so we're excited to see that popularity with investors. So we're going to talk about cash flow, making sure rents are acceptable in the market, talk about ancillary income, asset appreciation, and how folks can make sure that they have a plan for that, potential tax benefits, how you can defer some, and then pass along cost savings or depreciation to your investors or yourself if you're a single investor, and then those long-term approaches for real estate investing, and how people can look to the future. So with that, we'll start talking about trends. So many investors, and this is based on a lot of data from Preqin, they are starting to look at their investment strategies and looking at their risk exposure and those macroeconomic developments. And Dustin and I saw this a lot in 2024 as we were talking to people. They were like, it's an election year. It was an election year in multiple countries, and people just weren't, sure what was going to happen with fiscal policy. And fiscal policy is your taxes and tariffs, things like that. And then you've got, on the other hand, your Federal Reserve that sets the monetary policy and the interest rates. And so things were kind of up in the air, depending on who you ask and who you talk to. And so we had a little bit of a pause and wait. And in the commercial real estate world, you had a lot of extend loan extensions. So people extending, hoping for those rate decreases. So in the Preqin quarterly update, they show a chart that kind of goes back to 2001 and explains where people were putting their capital. And so a lot of folks have been focused on opportunistic since 2020, but you're starting to see that come down and that value add approach go back up. And so that's what we're excited to see, is folks going back to those properties that have good structure. They're in a great location. They just may have been built 20 years ago and need to be updated. And so that's really the core of this, is just seeing that those value added approaches had been very popular. Then they kind of shrunk in popularity as folks were going for new development, or they were going to fund of funds or debt funds. And now you see that value add and opportunistic strategy, especially if you look in the blue column, they're projected to do better in the IRR, or internal rate of return. And so with the value add approach, you create gain through increasing a property value in two ways. You want to increase through the value of the property through renovation. So it's more expensive. It's got these added values that also translate into increased income through your rent. So that would also be your NOI. So you've got the value of property through the renovations, making it more ready to be purchased. And then of course, the net operating income is the cash flow strategy. So again, value add strategies remain the top choice for both investors and fund managers. And as inflation is declining and interest rates are stabilizing, we do think that value add strategies, from a Preqin perspective, but also from talking to other industry experts, that value add is going to be well positioned and expected to benefit most from the expected rise in property valuation. So property value should go up as interest rates come down. And then, of course, you see in the chart that in 2023, you were starting to see the opportunistic and value adds become more interested for real estate investors. Still have some folks that are interested in distressed, and you will see some of that happening as folks weren't able to do the extend and pretend method of getting their loans figured out. So also the cost of building. So Colliers did indicate that the cost of building is hard right now. So a lot of people are going for properties that need value add, or they're opportunistic because you wouldn't be able to replace it, rebuild it, knock it down and rebuild it for less than actually renovating it. So the other question we get a lot is, well, if industrial was so popular and debt funds were so popular, why multifamily? And I always tell people, because you got to have a place to live. And single family rentals are great, but sometimes, especially with most of them being held by independent rental owners, just someone who owns maybe one home or maybe two homes, if they're tied to leverage, then that can make that rent really expensive. And sometimes they end up losing money for a spell, and are just, holding on to the property because they have equity in it. And so multifamily is great because you can spread that risk over a whole building. So if you have a couple of units go down, for whatever reason, or they're not occupied, then it's not the whole building, as in the case would be with one house where you only have one resident living there. We also see a supply shortage. So there was a 4 million home shortage, and we're not catching up. I think they're building about anywhere from 300 to 500,000 units per year. And 4 million is still, there's years of supply that need to be built. And so the Sun Belt markets will continue to see that supply increase. People don't like the snow. If you're in the north right now, I'm sorry that you're frozen. A lot of people have moved to the Sun Belt to thaw out, especially as they age or they have grandkids and folks that they want to be around. And so what's going to happen is those lower metro areas that didn't have supply, maybe in the Midwest and the Northeast, they're going to start to see that rent grow at a higher pace. And then towards the end of 2025, if you look at the chart, you start to see that the supply, while it's been going up, is going to come down and the demand is actually peaking. So you're starting to see that balance towards the end of 2024, and that's projected to continue in 25. And then what has been built are these 4 and 5 star properties. So when you think about brand new properties with all the bells and whistles, so those 1 to 3 star properties, which are usually your B and C properties, there's a lower supply of those. And those are usually your prime candidates for renovations and a value add or opportunistic approach. So we continue, and as you see by CRE Daily, when we talk about multifamily maintaining its dominance, it represented 35% of the sales volume in 2024, and will continue to see a high turnover in 2025. So we are optimistic on the outlook of the supply and demand balance. As I said, you're starting to see that on this chart come into more of that more stable balance. And then we think in 2025 that there will be a foundational sector in our portfolios, our US investment portfolios, with multifamily real estate, because it tends to be more of that stable asset, because everybody needs a place to live. We also think that vacancy is going to trend down in 2025. So vacancy is, the homes that are not, or the units, apartments that are not occupied. So while there's been a surge in completions over the past 2 years, we think that that absorption or that demand is going to fill it. And with not building anymore, not having that glut of supply, that things are going to kind of balance out. So you should see vacancy trending down. And of course, the high cost of home ownership is going to keep people more in that renting stage until they can figure out interest rates, if they're going to have those 2 decreases this year, or if they're going to kind of, like we said, kind of stay stabilized. And so with it being a new transition to a new administration, I think everybody's kind of in a wait and hold period when it comes to home buying. So that's where we hope to see the demand stay the same or increase for multifamily. And then of course the supply is going to level out, and then that means that rents can go back up and concessions can go down. So when we talk about multifamily, a lot of times you'll hear brokers talk about cap rates, and the cap rates is a snapshot in time of the value of the property, or the projected return that you could get. So in CRE Daily, they talked about this window of opportunity, that there are some assets out there that folks could acquire below replacement costs in some of the high growth areas. So in secondary markets, which are more of your secondary cities like Raleigh or Nashville, you're seeing cap rates around 5.5%, 4.8%. And they think that these conditions and the stabilizing fundamentals will make multifamily, especially in these secondary areas, the top pick for 2025. So multifamily cap rates are projected to compress in 25. We'll talk about that on the next slide, but that is, it can be good, it can be bad. It really depends on your strategy and what you're looking for in a return. But like I said, we'll talk about that a little more in depth next slide. But with rent growth, which also impacts value, they do project, Colliers projects that rent growth will be stronger in 25 than it was in 24. And then 26 is poised for stronger growth. And a lot of that goes back to that supply. When interest rates were lower, developers could go out and get cheaper capital. And so when they were doing that, they were able to build. And so when you build, you have about an 18-month window to stabilize. So every kind of 6 months you're throwing off units and your team is leasing those. But it tends to be about an 18-month process for you to get to that stabilized part. And so when you have a supply slowdown, then you can grow rent because then you have, more stability there. So cash flow strategies. We talked in our advertisement for this about cash flow strategies because a lot of times folks get into real estate investing and they are thinking about the value of the asset and the appreciation, but they're not necessarily always thinking about the cash flow, or maybe they're just focused on the cash flow, but they also need to focus on how to continue that after year one. So cash flow is the income remaining after all the expenses are paid, including the taxes and the financing costs, which we'll talk about financing on the next slide. But when people ask me, okay, so how do you increase cash flow? And I was like, well, pretty simple, or maybe it's too simple. You increase income, you decrease expenses. And they're like, so which do you do? And I'm like, well, you really do both. You want to always focus on doing both. There are going to be cycles, there are going to be times where you can't increase your income, which is your rent growth. Maybe the cycle has changed and now you're people on renewals that are coming up to maybe sign another lease with you are actually paying more than the new people coming in. And so you're kind of stuck with your income, maybe where it is. You may be looking at it backing up a little bit. But what you can do with expenses is go back and try to renegotiate, try to maybe save some of those renewals because when people move out, you have to renovate, whether it's just cleaning and painting, you still come up with some costs for people moving out. And so really focused on what you can do in both sectors, whether it's increasing your income or just maintaining. And then with expenses, can you decrease them? If you have less move outs, then you're going to have less expense. Also, if you're keeping people in, then you're going to have less income with application fees, things like that. You just really need to make sure that you're balancing. Of course, if you're not getting an application fee, you're not running an application, so you save on the expense. So it's just one of those things where you really want to be diligent with your budgeting and understanding your market. And so on the income side, it always goes back to your biggest income driver or your rents. So what are you charging? Are you charging in line with the market? It's a really hot topic right now because of some legislation and some in some different areas, but also some folks, who had their pricing kind of on autopilot. And so you really want to understand how your rent pricing is structured, how it looks within the market, and then also why it's unique to your property. What are your attributes that are unique? And what are you charging for more short-term leases, long-term leases, and how you're balancing those out. Unless you're a student property where you're going to turn over in the summer 100%, you really just want to understand what you're charging and that it's fair and balanced and based on current conditions. And then your fees. I just saw an article about a large company out there that is being sued for their fees. You have to ensure, and I'm not saying they are or they aren't, ensuring that their fees are covering appropriate expenses. What I'm saying is, as an independent investor or rental owner, you want to make sure that you could justify your fees, that those are actually charged and are covering an expense. And then look for those ancillary income opportunities. We see this as we're underwriting properties. They'll say in the pro forma, hey, you could charge for valet waste, or hey, there's a spot for a billboard. And that's true. There are lots of opportunities where people just haven't wanted to expend the energy to go through and sign a contract and offer valet waste or covered parking or increased tech packages, like maybe a keyless front door lock, or you can do a code or with your phone, things like that. Or there's some other services like partnering with a company that can do positive credit reporting so you can help your residents build their credit. There are different ways that you can add some ancillary services. So always do your research, shop your competitors, see what they're offering. Is it a customary service in the market, and could you increase income by offering that? The other part of that again is the expenses. So there are some non-controllables. We right now we all have property taxes. So you want to make sure as you're looking at a property, you understand the current rate, but also the projected rate. Just had a bunch of elections. So there's usually proposals on there when you're voting. So you want to make sure that you understand, did anything change? Especially if you're looking at a property and it's not in a city that you're familiar with. Did anything change? Are there opportunities? Is there opportunities for reduction if you're going to change the value of the property and it might impact it negatively? Could you get a rate adjustment for a year? And also, if you're developing, understand that that's going to impact your pro forma, because once you put an improvement on a property, that increases the rate. The state, county, and local fees. This is an interesting one. A lot of people, especially independent rental owners, don't realize that the city or the municipality may charge a fee for you listing your property as a rental. And it could be on a per unit basis, on a per company basis, it could be annually. A lot of times it's an annual fee plus an inspection fee, and they're looking for certain things. And if they don't find the certain things, or they find things that are negative, then there could be a per day fee for being out of compliance. You really need to understand that local area and what's going on. And then, as we, unfortunately, people are dealing with hurricanes and fires and floods throughout the year, insurance is a huge topic in real estate. A lot of companies are pulling out of certain states, or we've seen it where insurance rates go 300% higher than they were. And so it's really important to understand, for that property type in that area, what's the current rate, what are they trending, what have agents in that area seen as a change, and then understand the coverage and premiums, because um, you want to make sure that you get what you're paying for, but you understand what you're paying for in case of an emergency situation. And then controllable expenses, utilities, marketing, admin, personnel, especially with utilities, making sure that the last owner, they may not have done low flow plumbing fixtures, and that could be something that could really save on that water bill. They may also have had, sod and other like ornamental plants, things that were very water heavy, and a zero scape may be a better option. And so really doing that cost benefit analysis with your utilities. There are a lot of brokers out there in a state like Texas where electricity, you can use retail providers. There are a lot of ways to save money on electricity, things like that. Marketing, making sure it makes sense. Sometimes property managers will put marketing on a kind of set it and forget it plan, and you really want to make sure you're getting your money's worth. The same thing with your general and your admin costs. That could be your, there could be inefficiencies there. So just make sure that you're looking for a way to value engineer your general costs, your administrative costs. And then, of course, your personnel. Are you right sized for the property? We hate for people to lose their job to technology, but is there a way to reallocate personnel in a way that they're more efficient, they're more happy, and that you could also leverage technology to do some of the tasks that, really are auditable by electronic personnel? So AI can help out a lot with that and bring you more savings. And then, of course, capital improvements. You want to research as you're putting your budget together, but as the year goes on, you want to make sure that that cost benefit analysis is still accurate. We ran into this in 21 and 22, where supplies, all of a sudden, windows were really expensive, or we couldn't get a certain thing. And then that let the whole, like, we couldn't get paint because they had parts of the supply, but they didn't have the whole thing, so they couldn't make you a gallon of paint. So nobody was getting paint, didn't matter which brand you used. And so with that, it threw timelines off. Maybe you had to, tell somebody you would paint the apartment, in 3 months, almost like give them a little IOU fresh paint at renewal kind of thing. So you have to get creative sometimes, but you also need to understand that the budget you wrote in November of 24 may not be accurate in March of 25 because of supply chain issues. So just always be paying attention. And of course, um, we've seen this happen in renovation projects where what was working in the year before and everybody was getting maybe a $300 rent bump for doing this upgraded kitchen. Now all of a sudden things have changed, the economy's changed, and you're not going to get $300. You're going to get $150 maybe. And so does it still make sense? So I've worked on projects where we put renovations on hold, where we scaled them back, where we only did them on renewals. So you really just need to make sure that with these capital improvements that you're paying attention to the market and tracking them closely. Um, we did talk about your financing costs and how looking at cap rates is important, but also understanding how much your capital is going to cost. And so when I talk to people about their interest in real estate investing, I also talk to them about, well, how much money are you going to put in? Do you know the loan to value ratio of your preferred senior debt? And sometimes I get this glassy look. And so just wanted to put a slide in here to remind folks to make sure that you understand the financing cost. So are you going to go to a bank? Do you have that relationship established? Do you have a broker, a mortgage broker who has that relationship established? And if you need to do renovations, would you then come in with some mezzanine debt or a short-term loan, like a construction loan or a bridge loan, to get that done so that your cash flow goes back up and you can increase that value? Or do you need a strategy where you have the bank loan to buy it, the mezzanine debt to cover that construction or renovation piece, and then maybe to get the bank loan, you offered some preferred equity. So you had some folks that came in and said, okay, I need X dollars. And this is the project, and then I'm going to give a minimum return, a preferred return. And sometimes there has to be some common equity that comes in and say, okay, after all these folks are paid, then I will pay you. And so that is typical in a cap stack of seeing, the senior debt, maybe a bridge loan, preferred equity, or common equity. And sometimes it's a combination of all four, sometimes it's just two. It really depends, but just make sure you understand how you're going to finance it or put it together and how that's going to impact your cash flow. Hard money rates versus long-term financing rates, just make sure you understand in your projections where that's going to land. You also want to factor in if you're going to be able to refinance it. And if you do, are you going to pull out that cash or are you going to leave it in? Is that going to be to fund the next wave of renovations? So just really have a plan for that. And then, of course, understand amortization schedules. Are you doing interest only? Are there prepayment penalties? So really pay attention to those terms as you're looking at term sheets to put together your plan. And then on to asset appreciation. So folks say, okay, well, how do you know when to buy it, when you sell it, and when do you just hold on to it? And a lot of times that is figuring out where we are in the real estate cycle. So there's four stages to the real estate cycle. It does not always correlate to the Wall Street, the market, so the stock market. So typically you're going to look at them separately. Whatever's going on in the stock market, that's nice. But real estate is a hedge or a different way to protect your money outside of the stock market. So there's, like I said, four stages, and it also can be very regional. So when Dustin mentioned getting into real estate, when we were out in Phoenix, it was very different than our family back in Texas was telling us. So we were actually in a different real estate cycle in Phoenix than they were in Texas. And so we kind of saw that recessionary downturn, and they were still in hyper supply. So they hadn't hit recession yet. And so it's very important as an investor to understand globally where we think we are in the real estate cycle, but then understand where that local metropolitan statistical area is, and then also where the submarket is. So right now, I would say overall, we're kind of in that hyper supply moving into recession. But if you go to the Midwest, they'll be like, oh, no, 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 we're actually kind of in recovery. We're feeling good about this. So they actually have higher prices. And so it can be very finicky about where it is. And then in going back to the cap rates, when you're looking at an area, you do want to look at the rent growth, which goes into the real estate cycle, but also the cap rate. So you want to understand where they have been on like sales within the last 6 months, where they currently are, and then what's going to happen with the supply and demand for that property type, what could actually change the NOI and the property value, how that's going to impact the cap. So typically with the cap rate, the higher the rate, the greater the risk, and then also higher return. So you have that higher return possibility, but for that higher return, you're taking on a greater risk. And so really understanding the cap rate for that area is going to tell you about a range of values and a point in time of value for that particular asset. And really what cap rates are used for is to look at another deal in the same area and go, okay, this is a 6 cap, this is a 5 cap. If I do what I want to and the values stay the same, how is that going to impact that cap? And does that work with your return and your goals? Another big part of this is your job growth. So you want to look for employment areas where you're going to be able to have a steady flow of new people coming through. Population growth is tied to job growth. If there's jobs, there's typically people moving in to get those jobs. And of course, that ties into the absorption rate of the new housing supply. So these are just things to look for when you're looking at asset appreciation. Will an asset stay where it is now? And does it have the ability to appreciate? If you're looking at a market and they're laying people off, population hasn't really changed in the last 5 years, not looking to change, then the asset appreciation value is probably not going to be high at all. It could actually then decline. And so you just want to be very careful as you're doing your due diligence. When buying or holding a property, you always want to look for ways to enhance an asset. And so a lot of times value add folks will not look at brand new properties. And I always love, but there's always some meat on the bone. And I know that's, you know, people don't want to hear that, but there's always something that could be done better on a property. And so when you're looking at deals, make sure you understand where the property is now. If you can figure out why that person's selling, sometimes it's because, the owner is retiring, the kids don't want the headache of the property. And so they just stopped doing renovations. So there's maybe like 10 or 15 units left to do renovations on, or they knew they needed to add Amazon package lockers. They just didn't want to go through the trouble. And so they were okay with what they were making. So that could also be on newer assets where the developer just said, I'm going to go to this point. This is what the return I want. And whatever's left, somebody else, the next owner can take it because they wanted to continue with their development business. So there's different reasons people sell, but look for ways to enhance that asset no matter what it is. So a lot of times you can increase the income through those renovations in technology. You could add different amenities to the actual unit. You could add amenities to the property, very popular or pet related amenities. So dog washes, dog runs. We've seen people turn old conference rooms into podcasting spaces. We've seen folks who had a utility closet that didn't have washers and dryers, add washer and dryer connections, and then take that old laundry room and turn it into a co-working space. You can get really creative, and definitely by looking at new properties in the area, you kind of understand what people are shopping and what they're used to. And then you can turn that into a cost benefit analysis of updating your property. And of course, always look to reduce expenses to help increase your NOI. So looking at your vendors, negotiating with them, adding devices or programs that will reduce vandalism. So maybe the property's never been gated before. Maybe it makes sense to now gate it, add some cameras, possibly, have courtesy officers there, different things that you could do to help, raise the value of the property. And then risk mitigation. So um, with looking for asset appreciation, you also want to look to mitigate risk. It's possible that there are areas or properties with potential for appreciation. So they could be an older vintage property in a great location, a new development coming in the area to revitalize it. So if you were able to gate a property and put cameras on it, would that increase the asset but also mitigate some risk? And then, of course, looking at the insurance cost, can you harden the asset to help with some of the flood zone issues? Or could you add different things that would help it with a hurricane? So shutters, different things that would be more, like I said, hardening the asset. Or does it need sprinklers? Is it an older property? You're in a fire zone? Maybe putting in some, working with the fire department and the insurance company and making it a little bit harder to catch fire, those sorts of things. I would always recommend for risk mitigation, you hire reputable property management as you're doing due diligence. You look for reputable contractors, inspectors, and engineers, and that you have the appropriate legal team, insurance folks, accounting professionals, that they review everything, especially those claims histories, and just really do a thorough due diligence for the property, because that's going to help you mitigate some risk and some expense. And then, of course, you can use that to appreciate the asset. I know we're running up on time, and everybody always wants to talk about taxes and how they can save. Sometimes saving is deferring, sometimes saving is actually through depreciation. So depreciation is one thing that's tied to real assets, real estate. And usually with multifamily assets, um, because they're considered residential, they're depreciated based on a 27.5 year lifespan. So that's just on the improvements, not the land. You're still going to pay full value of the land on taxes, but you can devalue or depreciate that building because it's losing some of its value based on wear and tear and depreciation. There's another thing, so that's usually just a standard deduction every year off the expenses. But with accelerated depreciation, if someone is putting like new appliances, new roofs, and all kinds of new um things into the asset, then it might be worth a cost segregation study where they go through and say, okay, a new faucet is this, and a new roof is this, new appliances are this, because then that depreciation can be accelerated to the front of the ownership of the property versus just spread equally over the years. You still can't exceed the value of the property. You can't depreciate it more than the value, but it is a way to tax plan and look for those savings. It is going to be recaptured at the end, so it's not free money. Depreciation will be recaptured as ordinary income, and then the capital gains tax rate does apply for profit after depreciation recapture. So they do look at that, and then of course it's related to the cost basis of the property. And if adjustments are made, that cost basis can be adjusted. Pass-through tax deductions are a little different. So most real estate investor income is passive, which means that only passive losses can offset passive income. And so with pass-through tax deductions, that's what you don't get with a REIT. So when people invest in a real estate, especially like a public real estate investment trust, they're not getting the pass-through tax deductions. When it's a partnership or some fund investors, then they get a K1, a schedule K1, and on that they would get some of those pass-through tax deductions. And so that's one benefit of doing real estate investing with either yourself in a partnership LLC or a fund or something like that versus a real estate investment trust. And then of course, another benefit are capital gains tax rates, which are typically owed on profits made from the sale of assets. And it depends on few things. What was sold, how long it was held, was it held less than 12 months or was it held for a longer term? The owner's taxable income, so the person getting that K1, what was their taxable income? And then the filing status of that person. But those are typically rates that are lower than the person's ordinary tax rate. And so that's another aspect of real estate investing. A big one is the 1031 exchange. So a lot of folks who've been in real estate investing for a while, very familiar with this. If you're not, please do a deep dive on 1031 exchanges before you try one, because you have to have certain key people in the process, and also there's very strict timelines. And so you don't want to think you know what you're doing. You want to know that you know what you're doing. So when thinking about a 1031 exchange, there's like kind investment properties. So that matters. The use of the property matters. So if you sell vacant land and then want to turn that go into a commercial property, that's not the same, because maybe you were ranching on this land and it was a personal use. And then over here, you're, actually putting it into a business use. So it really you need to talk to somebody, you need to talk to legal and tax to make sure that if it's just personal going to business, it's not going to be the same. It needs to kind of be business to business, that sort of thing. The potential gains are being deferred. That doesn't mean that you never pay taxes. It means it's being deferred until the last property is sold and not 1031 exchanged into another property. The taxpayer has to be the same on both titles. So if it's, ABC LLC on the property being sold, then the new property being bought needs to be ABC LLC on the title. So it very much has to be the same. You can defer tax on gains to another property until the final property is sold, like we said, but you can't take the proceeds from the property being sold or relinquished. And so once that property is sold, a qualified intermediary has to hold on to those funds, kind of like a custodian, until the exchange is complete. So 45 days from the day that you sell the relinquished property, you have to identify a list of potential replacement properties. There's a couple of different ways to do that. So there's three types of lists. So like I said, do your research, and then within 180 days, you have to complete the exchange, and that all has to be done with a qualified intermediary. So to be tax-free or deferred, the replacement property must be equal or greater than the adjusted price, sell price of the relinquished property. So you're kind of looking to put the same amount of debt on the new property. And then it must have, like I said, mortgage debt or new cash added equal to or greater than the mortgage paid for the relinquished property. And so any cash that's left over is considered boot. So kind of reminds me of a pirate. You got this leftover money. It's considered boot and is taxable as capital gains. And so just understanding how this all works can help you plan to scale up investment. So a lot of people do a 1031 exchange in order to scale their investment up. And then the last thing we'll cover before questions is long-term real estate strategies. So a lot of people come to me and we talk about our fund and whether it may or may not be a good fit for them. But then we talk about things that they've done before. And a lot of times I hear about buy and hold strategies. So typically you'll see a family maybe buy a vacation property. They have their personal home, they rent out their vacation property, and they hold on to it for 20 years because the intent is to keep passing it down and it's always in the family. So that's a buy and hold strategy. Um, and so I just always tell people, you can do it on a 1 to 4 unit. And if that's manageable for you, then just make sure your leverage is appropriate and your capital stake stack makes sense for the length of your hold, and understand your liquidity. Like, are you going to be able to make your payments? Are you going to be able to maintain it? That sort of thing. And then, of course, as it appreciates, that's always, something to consider. There's a big popular trend, especially on social media, of the do it yourself or the BRRRR method, which is buy, renovate, rent, refinance, repeat. That is where you have full control, but also full responsibility of the investment. And it is usually self-managed, so folks can save on costs and increase their NOI. I've seen some people and talked to some folks who've done house hacking, which is where they maybe buy a duplex or a quad and they live in one of the units or one of the homes. And then their cost of, the mortgage is offset by the rent that they get from the other units. But again, it's a lot of do it yourself. It's a lot of sweat equity. So there, but that is a long-term strategy that they've used. And then of course, for folks who are like, I like the idea of real estate, but maybe I'm not an accredited investor yet. How can I get started? Um, Publicly traded REITs are a great way to learn about the business, learn about what's going on, and keep up with real estate. It definitely is different than a private fund, but there are ways to, see how the market is impacting the real estate cycle and how the REITs are trading. Um, there's quarterly dividends, and so that can help, make sure that folks are diversified in their portfolio. But the tax savings are limited because the REIT is basically keeping the tax savings and they're passing on the income to the investor. So the investor isn't going to get the tax savings that they would through a different kind of fund. So that's the difference. So with that, we will go ahead and open it up for questions. Dustin, do we have any questions?
Sorry, I had to take myself off mute. I have not seen one question come across yet, but I would like to ask you a question.
Sure.
So the other day, a guy approached me, and so he's thinking about buying a single tenant. Keep in mind, it's single tenant Starbucks. The cap rate is 6.25%. It's a 5-year lease with a 5-year option. He said, why should I invest with you? Or why shouldn't I just go out and buy this single family, or I'm sorry, single tenant Starbucks on my own? Keep in mind, he had his own individual retirement account of 500,000 that he's going to put down.
Well, it sounds like he has done some research. If it were any other coffee shop, I would say I would be a little more concerned, but Starbucks tend to not leave locations. So really, I would have to meet the person and talk about their long-term goals and talk about what we do in the fund and whether our preferred return is going to be more than what he is projecting to get his average annual rate of return. You said 6.25 cap rate. Um, and long-term goals. I mean, Starbucks is a pretty stable company. Obviously, we've all heard of Starbucks. So if he's committed to being able to have that one tenant and understand that there's risk if everybody stops drinking coffee tomorrow, not likely, but it could happen, or if we have a shutdown, is he confident that he wants to be in that type of commercial real estate? So it's just a conversation of risk tolerance and what people are looking for. And you mentioned self-directed IRA. So that is something that we're going to have a webinar on February 5th. So Paul Herbis from Equity Trust is going to come on with me and explain what a self-directed IRA was. And that was actually something that I learned years ago. Actually, you taught me about it, and I was able to leverage that as I was changing jobs, and I was able to take an old 401k, and I just, was able to turn it into something that I could direct the investment to. I couldn't title things in my name, and used a custodian, but it was great to have someone like Paul in a different company explain that and help me with that. And so again, that's a good way to, like you said, invest in alternative assets. But for this person, I would definitely say it's worth a deeper conversation on, why a triple net commercial property versus a multifamily property and just different ways to mitigate risk.
Yeah, I mean, my issue was it's single tenant.
Yeah.
And I mean, I've heard Starbucks, they just shut down about 150 Starbucks, and it could be more across the United States in the past like year and a half. So,
Yeah.
I mean, me personally, I would rather put my 500,000 into multifamily, especially a 200 unit property. Because if you lose one tenant, you only lose one tenant, you still have 199. But it looks like everybody is shy today. They don't have any questions. So,
Well, we do appreciate your time and we do want to give you back time in your day. We know it's very valuable and precious. And so we're honored that you guys showed up. Like I said, February 5th, we'll have that self-directed IRA webinar. So if that's something that's interest to you, or even if there's somebody in your family who has questions about investing, just period, that's a great way to get some education. Next steps, if you're interested in our fund and how we take real estate and help people scale into larger investments through the fund mechanism, you can schedule a call with us. You've got our QR code there on our, and you can also just go to our website. Our resources and our blogs page is definitely a great place to learn more about real estate investing and what an accredited investor is and kind of how we view real estate strategies. And then of course, upcoming events and webinars will always be updated there. So with that, nobody has any other questions. Again, oh, I see something popped up. What is our preferred return? Our preferred return is not something that we're going to cover on this webinar because it is open to all an audience of everyone. So with our fund, we have it's open to accredited investors only. And so there is a preferred return, but it's something that we would talk about one-on-one. It is in our fund document, but that is again just for accredited investors. So if that anonymous attendee would give us a call or shoot us an email, we'd be happy to schedule a time with you guys to quickly get that information over. Well, with that, we will let you guys go. This is actually recorded, so you should have ability to come back and rewatch. And then for those that weren't able to make it, they will be able to see it as well. And then with that, we will go ahead and let you guys go. So thank you so much again for your time today
bye,
and
guys.
have a great rest of your day.